Hello, everyone. My name is Frank Napolitani, and today we're talking alts with Patrick Campo of Titan Advisors. Patrick joined Titan Advisors in 2013 and is a director of research. He's responsible for long-short equity and event-driven strategies and contributes to the portfolio construction process for all of Titan products. Prior to joining Titan, he spent 4 years with Alternative Investment Management as a partner and the head of research. Previously, he was with EIM International, serving as partner and the global head of long-short equity strategies. He started his career at Goldman Sachs and JP Morgan. Welcome, Patrick.
Thanks, Frank. Happy to be here.
Could you spend 2 minutes on Titan Advisors and your role at the firm?
Sure. So Titan Advisors was founded just about 20 years ago by George Fox, who's obviously still with us. And we started really as a commingled fund of funds. We had one fund, and as we've grown, we've adapted with the market. So today we still have that fund, the Titan Masters Fund. But like other shops, we've had to adapt with the market as the landscape has changed. So today, when you look at our firm today, we have the Titan Masters Fund, we have insurance dedicated funds, we have custom portfolios, we've seeded 2 managers, we've accelerated a 3rd manager, and we advise or consult certain large pensions in Canada as well. So it's really a diversified allocator. We're a diversified asset manager based in Connecticut, but it's all built on the same engine of doing research on the hedge fund universe. And currently our asset base is roughly about $4 million, by the way.
Excellent. Well, thank you. Pleased to have you today with us. And before we dig into the question and answer portion of the interview here, I'd like to just summarize our current investment landscape based on yesterday's close. So S&P 500 year to date as of yesterday, which is June 8th, down 4.87%, peak to trough being March 23rd, down 30.7. However, since March 23rd, as of the close yesterday, up 45%. Tech-heavy NASDAQ as of yesterday, up 9.99% year to date, peak to trough down 23.5, and as a rebound from March 23rd, up 42%. Switching gears to hedge funds, the HFR weighted composite, this is as of end of May, down 4.84% year to date, and year over year, up 25 basis points. One final stat, U.S. unemployment currently is 13.3% with 21 million Americans out of work, which is a decline of 2.5 million from the April report, which came out last week, which I think was a big surprise to a number of people. All right, so why don't we dive right in, Patrick? So, this shelter-in-place quarantine has affected a number of people. So think about investment due diligence. How has it affected how you go about your investment due diligence process the last 3 months?
Sure. So I was pleasantly surprised not surprised. I was pleased with how Titan has handled the shelter in place, and specifically with our team. What I found was it was honestly quite seamless. All of us were told to shelter in place. We all went back to our homes, logged on. Our tech team did a great job supporting all of us. We were able to log on through our secure networks. We, unlike a lot of others, we use Microsoft Teams, which is actually a great piece of software that allows us to really everything from store files, communicate, and also do quick video calls. So we've loved using Teams, and it's been seamless. Our conversations with our European office as well as our U.S. office has been terrific. From a day-to-day standpoint, I think there were 2 things that happened. Number one, we were all shelter in place, but the second thing that occurred was that we were going through the March sell-off. So that was pretty aggressive in terms of covering managers. And what I would say is that, we were, each one of us, I think we were all working 12 to 16-hour days on the phone with our managers, making sure that we understood the risks in the market and that our managers understood the risks that we were seeing. Because I think at Titan, we do sit at a pretty nice intersection of being able to see the landscape, see what's happening in the credit market, see what's happening in merger arb, see what's happening in long short. And we're able to convey those notes to our managers so that if a manager is just specifically focused on, say, technology, they might not know that merger arb spreads are blowing out. So during the month of March, we were able to give those give that information to our managers so that they can effectively manage their risk. So it was really all hands on deck. We were working very hard, and we continue to work very hard. As you can see behind me, I'm back in the office. We were pretty quick to open up when state of Connecticut opened up. We opened up. We're not at 100% capacity, and we've taken a number of precautions to get the people back in the office in a very safe, effective way. That includes everything from taking the temperature in the office right when we get in to wearing masks when we walk around the floor, practice social distance. So
Excellent.
it's been good.
So the COVID-19 obviously affected the hedge fund market, like you just said. In general, without mentioning any names, how would you feel like, maybe your portfolio and or the market in general, things you've heard and some scuttlebutt out there, how the market overall, hedge fund market overall has performed?
Yeah, I think it was surprisingly, I think managers did on average in our suite, we invest in roughly 65 different hedge funds. The vast majority of our hedge fund managers did very well. They did very well, and they saw back in February 7th, Forbes wrote an article that 421 companies have cited COVID-19 as a very large risk to their portfolio. Number one. Number two, Wuhan by that point had already completely shut down. That's a very large city in China. And number three, any technology company obviously was citing the effects of having their supply chain get shut down throughout China, and there was real concern there. So there were a number of warning signs in the month of February and even in the month of January going into the March debacle, if you will. So many of our managers, the majority of our managers did just fine. They had to reduce their risk going into the month of March. When the sell-off, when the first signs of volatility really occurred in the last week of February, a lot of our managers had already taken steps to reduce risk and really prepare themselves for a volatile March. Having said that, I'm sure like others, we did have some managers that did not necessarily protect capital as well as we would have liked. And but what we found was very sporadic. We had a manager in merger arbitrage, and I think they were just a little bit surprised at the gap. There was a lot of forced selling in merger arb, and they were hit. They did better than a lot of other merger arb managers, but they didn't escape it completely. Secondly, if we look out, there were some credit managers, for instance, that got hit as a lot of repo lines were drawn in. So I think there were spots here and there of managers that really got hit, but overall, in general, we were quite pleased with how our managers fared. And I think that's really a testament to what we look for at Titan. We spend a lot of time on analyzing risk management and portfolio construction with our managers. So it's our belief that, these sell-offs, when they do happen, they tend to happen very quickly and very fast, and they can be very steep. And I think March was an example of that. So we try to we do a lot of work on risk management. We gravitate towards managers that really have an appreciation for the possibility of a sell-off such as this. We call it either risk management or just market savviness. Does the manager understand that regardless of the fundamentals of a company, their stock or their credit has the potential to sell off 20 or 30%? And what is their plan for that sell-off? So those are some of the questions that we ask when we look for managers.
Understood. And listen, the last 90 days have been really a roller coaster, as we've outlined before in the landscape. Has this created any opportunities, or are you focusing on any sectors more so than others, or have gotten maybe bearish in other sectors that you might have been bullish on last year or the prior years?
Yeah. So I think in general, we are gravitating towards in terms of sectors on the equity side, we're gravitating a little bit towards technology and healthcare. I think, obviously the healthcare focus is obvious. COVID obviously has brought to light and brought to the surface a few things. Number one, the amount of capital that's being spent on drug discovery and whatnot. Number two, the advancements that have been made just in the last 10 years and the speed at which drugs are getting approved. So, and we're not just seeing, we were excited about biotech in general going into this, and we're even more excited coming out. Second thing I would say is we're seeing some of the winners that have come from the shelter in place this was all made possible through technology, whether it's cloud computing or shelter in place and doing the video calls like we're doing today. A lot of these advancements in technology have only occurred in the last 10 or 15 years. So this is an area that's been exciting. We feel like those trends have been accelerated, and that would include e-commerce as well. So, but that has to marry the opportunity on the hedge fund side. So at Titan, we're constantly out in the market meeting managers and collecting data. So one thing we do a very good job at is really trying to capture all of that data so we can build peer groups. So right now, if you look at our peer group in technology, it's about 110 managers. So every single month we're recording those managers, meeting those managers, not meeting all 110, but we're obviously recording their data, we're analyzing it, we're making sure we're on top of that peer group. Similarly, in healthcare, there are about 85 different healthcare managers that we track. So those are, we need those two things to line up. We need a very robust peer group with good talent, and we need opportunities in the subset, in the sector they focus on. And we're finding that within technology and healthcare. It's not to say there aren't opportunities in other areas, but I can tell you in energy, for instance, the peer group in our energy sector is very small. A lot of the energy hedge fund managers that we track, they've had to shut down. So there are only about 10 managers in the energy space that we track. So that just makes it a little bit less of an opportunity from our standpoint.
Understood.
Yeah.
And switching gears slightly, and I know it's a big initiative at the firm, can you
Yeah.
speak to the ESG initiative at Titan and how you're focusing on that and building product around that?
Yeah, absolutely. So ESG has been a very large initiative for Titan Advisors. And about a year ago, George Fox, the founder, met with a woman named Anna Marie Washer, who is the founder of Flat World Partners. And Titan created a joint venture with Flat World, and it's called the Titan Eclipse Fund. So it's 51% owned by Flat World. It's a woman-run organization. And the idea was we were seeing a lot of opportunities in ESG, but we were finding that there's a pretty large gap in the alternative space. There are ESG long-only funds, there are ESG private funds, but there really wasn't a good response for or a good solution on the hedge fund side. So what we're doing is, as with Titan Eclipse, Titan, along with Flat World, we're actually going out and creating a multi-manager portfolio, and the layer of ESG rigor sits at the fund-to-fund level, if you will. So we're working more as a partner with the hedge fund managers. We're having them create a new share class or a new managed account. And with that, we're screening the portfolio with them. We're helping the analysts and creating questions for them so that when they talk to the companies, they know what to ask. We're highlighting different ESG risks. And it's our belief that we're going to have one of the better solutions in the marketplace in the hedge fund space. And then one thing I would add to this is we're also having them we're actually creating an emerging manager portfolio as well. And the reason why this is important, there are a number of pre-labeled ESG funds in the market, but many of them are very, very new or they're very small. So for an institutional client, it's very difficult for them to put real capital behind these. So it's our hope that our portfolio will be able to solve both answers, have a place where institutional investors can invest in, but also be able to sort of seed these smaller, newer managers that are dedicated in ESG and help them grow. So we're right at the early stages of this. We spent the last 6 to 8 months working with managers creating this. We have a model portfolio ready to go, and we're really excited about it.
Well, I can tell by the demand. I don't know if it was yesterday that I saw this on CNBC or maybe it was Friday, but it looked like there was $12.2 billion that flew into or came into ESG and during the first quarter. I think that might have been a Morningstar quarter. I don't know if you saw the same thing.
Yeah, the amount of capital that has gone into it has been extraordinary. And what I would say is that at least from my standpoint, I think one of a good way to view this space is it's a risk factor. ESG investors are very, very good at looking at alternative data sets and being in tune with different risk factors. So if you show a stock, for instance, a company that does not have good governance or does not have strong diversity or has large pay gaps within their company or does not care about the society that they inhabit, then they're actually generally more likely to be somewhat bad actors in other areas. And we see that if a stock actually has a black swan event where it might drop 80 or 90%, it's many times more likely to have negative ESG scores prior to that black swan event. So, and we see it time and time again. So, show me a company that doesn't score well in ESG, and I'll show you a company where generally there are other risk factors that might come up months down the road. So, a lot of these, it's what we're finding is fundamental long short managers. Um, are very excited to learn more about these risk factors because they know that this can help them as a fundamental investor. And ESG investors, I can tell you, were actually very early to catch on to COVID-19. They were very early to see what was happening in China. They're very early to understand the risks of pandemics. And what we found, just anecdotally, was that many of these funds were already reducing risk going into going into March.
Understood.
Yeah.
So thinking about how how you allocate capital to hedge funds and taking the fundamental side of it, just the process of how you invest. So you mentioned you've seeded managers before,
Yeah.
you've done separately managed accounts, maybe some acceleration capital from time to time. Can you talk about what drives the process behind A, wanting to seed a manager, B, wanting to do a managed account from a tactical perspective, acceleration capital from the business side, and just overall how you invest in directly in the LP as well as a normal allocation?
Sure. So it really depends on the opportunity set. And when we seed or accelerate a manager, it's very much done one at a time in a rifle shot. So unlike a lot of other competitors or some other competitors, they might go out and raise a blind pool of capital. For us, it's really based on the bottom up opportunity. So if we meet a manager that we think is exciting and we believe it's a very good seed or an accelerator candidate, we'll work with that manager, and for 3 months we'll spend our time doing the due diligence on the manager. We'll do the investment work, and then we'll have the operation team do the operational due diligence work on the manager, and then we go out and we actually market with the manager. So we put Titan capital into it from our funds, so that we're an investor. We're not just a marketer. We're an investor into those funds, and then we go out to our clients and to other possible clients, and we basically market with the fund and raise the capital together. Because we do this one at a time, it's very important that our seeds work. They have to be successful. So there's a lot of follow-on work that we have with the manager. And we help them with their interviewing process. We help them build their team. We try to help them with their business decisions going forward. And it's really a nice part of our business. Now, moving over to the managed account question. Excuse me. What I would say is that we generally prefer managed accounts. And having said that, we don't necessarily make it a requirement. It's nice to have. We're happy to have a managed account. It's something we're very comfortable working with. It obviously gives us transparency. It obviously gives us a little bit more flexibility too. If we find a low vol manager, we can put a little bit of leverage on throughout by underfunding the managed account, but it's not a requirement. And if we're again, not to keep going back on this, but we're very much bottom up focused. So if there's a manager that is dead set against offering a managed account, we're happy to invest in their fund structure. So I think the one common thread around all of this is we try not to have a lot of absolutes at Titan. It really is driven by the investment opportunity that we see in the marketplace and with the actual specific manager.
And you mentioned before how you're looking at tech and healthcare right now, and
Yep.
getting in those peer groups. So that's where you're at, and those are the funds you are actually tracking. I'd be interested to see how are you sourcing managers to become one of the managers that meet your criteria to get into that peer group. So, and especially
Yep.
as how it's been the last 90 days for the sourcing.
Yeah, sure. So it's really, we source managers any way possible, and we try to we go out to, obviously I'll speak pre-COVID, but we're out at the conferences. We have an office in London, our home office in Connecticut, and then we have a small office in Toronto as well. So we go to the New York conferences as well as any conference in the US. We go to the European conferences, the Asian conferences, and we meet managers, and the important thing is when we meet these managers, we try to collect and record their data. And I've been doing this for a long time, and what I find is that it's sometimes I find that a lot of allocators will go to the market and they'll get cards, and then those cards go into a box, and the cards aren't kept, they're not stored. Information might come to an email box, and then it's sort of forgotten about as the day goes on. We try to bypass all of that risk, and we try to collect the data and stay on top of it, so we're always current with the managers. And
And oh,
yeah,
sorry.
go on, Frank.
No, and one final question here. So let's
Yeah,
talk about successful managers. Like you said,
yep,
you've been doing this for a while.
yep.
Are there certain traits that these managers, possess that I don't know if it's their pedigree, it's their investment process, repeatable investment process, risk management, performance? Can you touch on some of those things that some of the most successful ones you've invested with, and if there are general traits across the board?
Yeah, it's a great question. And what I would say is that I think one of the biggest differences between Titan and other allocators is that it's we believe that managers, by the time they get to launching a fund and having their fund up and running, and they're at a conference and they've gone through the hiring process and they have their team set up, by that time, generally they know how to pick stocks. Generally, they're a very good stock picker. They know how to model companies, perform the channel checks, speak to management companies. Yes, there are differences here and there, but generally they're pretty good at the fundamentals of picking a stock. Many times they were analysts prior to starting the fund. Where we find big differences is in the portfolio construction and risk management side of things. And that's where we find huge differences. And what I would say is that with any allocator or any hedge fund manager, one of the biggest differences too is between any manager is pain and time. How much time are they willing to invest, and how much pain are they willing to endure? And if we can identify, if we can just get our arms around the investment horizon that a manager has and how much pain they're willing to endure, and what is the risk management process to prevent that pain or to stop that pain from occurring, then we've done a very good job of being able to effectively label that manager and be able to say, okay, we understand this manager. And for us, understanding the manager is half the game, because we do have many portfolios, and each portfolio might have a different risk appetite. Each portfolio might have different vol targets. So within that, we could have a high vol manager that has a very long time horizon, and that might not fit in one or two of our portfolios, but it could fit in this custom portfolio where the client is looking out 3 or 4 years. So
Understood.
yeah, so that's what I would say. It's we're really spending a lot of time on portfolio construction, and as we say around here, it's that market savviness, that ability to say, hey, look, the market's been up 7 days in a row. It's been up about 1% to 1.5% for 7 days in a row, not on the back of very light news. Maybe it's time to lighten up on some of these positions, or there's rumblings in China about a pandemic. Maybe it's time to do some work and bring down risk based on the run we've been on for the last year. Sort of this market awareness, and not just myopically focused on, is this company going to beat the quarter? Are they going to raise guidance? Just having a broader sense of what's happening in the world. That's really the type of manager that we focus on.
Understood. And
Yeah.
I'll push this back to you. Any final thoughts that you might have or want to pass along to our viewers?
No, I would say it's an exciting time right now. I think obviously for all of us, it's been a tragic time. Uh, personally, I have a friend that was in the hospital for 42 days and on a ventilator for 22 days. And thank God he's alive and he's out. So I think we've all experienced this personally, especially in the tri-state area. But having said that, if we can get through this period, get back to work and get on the other side, as allocators to hedge funds, it is a very exciting time. There's a ton of dispersion in the market. Fixed income finally does feel like it's not a great investment opportunity with the whole yield curve pinned to zero. And I think alternatives, it makes a good solution for a lot of portfolios that aren't comfortable being at all-time highs right now with 13% unemployment. So if people have a concern about being just long only, you don't want to be in fixed income, I think hedge funds, given the dispersion we see in the market, hedge funds make for a great solution. And many allocators can do it by themselves, but many can't. And I think when we look out to this community, whether it's Titan or one of our competitors, the service that is offered is extraordinary. So I think it's an exciting time in 2020. Hopefully the next 6 months are a little less volatile than the last 6 months,
Sure.
but we'll see. So
Excellent. Well, thank you, Patrick. I do appreciate you joining me today, and hopefully everybody else enjoyed listening to you as much as I enjoyed interviewing today. And I hope you and your family stay safe during this time.
thanks so much, Frank. It was great to see you.
Thank you.